like to start off today with a quote from Benjamin Graham. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. So this really sets it down straight. What is an investment and what is a speculation? Right? You have to do a thorough analysis. It has to have a promise of safety of principal and an adequate return. Those are the things we're looking for. So today we're going to be looking at an analysis of RIMM. We're going to look at it several different ways. We're going to look at its assets, its earnings power, and a little bit of its growth power. As we do that, remember that this is for educational purposes, both mine and yours, so take it for what it's worth. The first thing we're going to look at is book value. We have several different accounting entries here. Book value is basically the total assets minus the total liabilities, and you get the total equity, shareholders' equity, or book value afterwards. So if you think about it, for example, for a home, right? If you have a $200,000 home, it's worth $200,000, but you owe $100,000 in a mortgage. What you really own is that $100,000 equity in between what it's worth and what you owe. So that's what we're looking at with book value here. So if you took the total, I'll look at all the assets, it's worth $14.2 billion. All the liabilities are worth $3.8 billion. And so the leftover value for the shareholders is $10.3 billion. If you take all the shares outstanding, that leaves you with a value per share of $20.13, which is a 24% difference from what it's trading at today. Now we know there's some issues with book value. It doesn't always account for the value. It's a historic accounting of maybe what was paid for, or those type of things. So we're going to look at some other values, but book value sometimes is a good kind of rough measure to kind of get started. The next thing we're going to do is we're going to look at liquidation value. So this would hopefully be the kind of the rock bottom value that a company would sell for, and this is really what would the company be able to liquidate for. So we take all of our book values and we multiply it by a liquidation multiple to give us our liquidation value. Okay, so cash is worth cash, so that's liquidation multiple is 1. Our net receivables we have being worth, the multiple is 0.85. Inventory is 0.5. Other current assets 0.75. Property, plant, and equipment is worth 0.45. And then goodwill and intangible assets, we're saying it isn't worth anything. So that leaves us a total asset value, a liquidation value of $8.2 billion, with our total liability still being the same at 3.8, which leaves us with a value of $4.4 billion. Again, breaking it down per outstanding share would leave us with $8.61 per share, which is about half of what it's selling for today. So that gives me some comfort of, okay, worst case scenario, I lose half my money. That's not where I want to be, but worst case scenario, that's what occurs. Now with RIMM, I actually don't believe it's in a liquidation value standpoint, although the last several months it's traded pretty close to that, which is, in my opinion, a good opportunity to take advantage of the inefficiencies of the market. The next value that we're going to look at is replacement value. So how much does it cost for another company either to buy these similar type assets, or to gain kind of the similar market share that RIMM has? So if we look at this, you look at, again, we're taking book value as kind of a rough estimate of that value. If you were going to do this really in detail, and if we had the time to do it, and maybe one time we'll go through and really go through each line item and create a good value. But for now, we're just using book value. And the multiple is going to be 1. So we're going to assume that it's going to cost a new company that's coming in the same cost that it would that cost RIMM on their balance sheet to buy these items, these assets. The things that we've added to this is SG&A, which is sales, general, and administrative, and R&D. So the question is RIMM has all these client lists, they've had all these client relationships. How do we value that? Because a new company coming in, trying to get the same market position that RIMM has, would have to develop those. So how much would it cost them to develop those relationships, the technology, the infrastructure, all that, all that? What would it cost? So we kind of done a rough estimation, and we said it's going to cost whatever RIMM spent the last 3 years. That's what's going to cost a new company to get up to speed to where RIMM is today. And again, this is a rough estimate. You can disagree and say it's the last 2 years, 1 year, but what is the cost? So try to think about that. Okay, so that would be almost $6 billion for SG&A and $3 billion for R&D. So that leaves us with a total asset value of $23.1 billion, with total liabilities being $3.9 billion, leaves us in a value of $19.2 billion. And going down per share, that's $37.33 per share, which is a 130% increase to where it's currently selling today. We think replacement value probably represents the lower end of what RIMM is actually worth. We believe it's probably worth somewhere between the replacement value and the earnings value, which is what we're going to talk about next. So if you look at the earnings value, what we're attempting to do is take the operating income and then take all the adjustments, that have been made. What percentage of the R&D is actually for growth and not for kind of sustaining their current? We decided about 25% of their R&D, SG&A, and depreciation and amortization was geared towards growth of that spending. So we've kind of increased the operating income by those amounts, giving us an adjusted kind of operating income of $3.7 billion. So this is if they didn't spend any money on growing, what could we expect to take out of the company? Again, we're reducing that by taxes to give us our earnings power, which is $2.4 billion. And if we value that at a 12% discount, that gives us $20.5 billion. We then add the cash in that's left over from operations, which we estimate about anything in excess of 1% of sales. We add that back in to give us a total earnings power of $21.6 billion, which is a value per share of $41.95, which is about 170% difference from what it's selling at today. And so we believe it's worth anywhere between $37 something, I can't remember, replacement value, and $41.95. So anywhere in there, we think that's probably a pretty reasonable price for what RIMM is actually worth. We have our growth value here. That is basically trying to determine what part of RIMM's growth is actually adding value, because you can actually grow and destroy value. We put a multiple of 1.11, which gives us a growth value of $24 billion, which is a per share price of $46.57. But again, we're less confident in the growth value of that, so we're looking between the earnings power and the replacement value. And as you think about it, right, you're more confident about liquidation than you are replacement value. But you're more confident about replacement value than you are earnings power, and you're more confident about earnings power than you are growth power. The more you kind of go up that ladder, the less confident you are, because you're trying to predict the future, and that's very difficult to do. As you look at the assets, you become more confident about what the value is, because that's today. What are the assets worth today? What can you sell? What can you liquidate them for today? Replacement value, what would someone be willing to buy them for today, not 10 years in the future? When you start talking about earnings power, you're trying to predict what will the earnings be in 10 years, 20 years. That's much more difficult to do. So we're less confident. But because earnings power is so close to replacement, we feel relatively comfortable about that. Now, RIMM, obviously, its earnings will be very volatile in the coming future. It's a very competitive business, but we do believe that they have some stability based on their enterprise and their security system that they have, which makes it difficult for enterprises to switch to the current alternatives of Apple and Google. So that's kind of where we are in this analysis. Again, this is for educational purposes, both mine and yours. I'm kind of walking through how I would value RIMM. I would love to hear your feedback on what you think. Feel free to leave a response or email me. And I would love to hear what your response would be. So thanks for listening, and we'll see you next time. Thanks.